Greetings again, everyone. Jake Bernstein, Weekly Capital Markets Report. Sunday, December the 9th, 8:21 a.m. This is your trading lesson for the week. Oh, goody. There's no reason for me to do these lessons unless they're helping you. And there's no reason for you to come back here and listen to these lessons unless they're helping you. Otherwise, it's a waste of time. So let me hear from you. It took me a good 20 years to develop my trading style. And I still continue to tweak that style, to develop it even further. What do I mean by trading style? I mean the way in which I put together the various indicators that I've developed and study. You can put them together in different ways, but the most important thing is this. Always trade based on what you know, not based on what you think you know, not based on what someone else told you, only based on what you know, because even knowing what you know is not a sure thing. We know seasonals. Even if they're 80% right, 85% right, even 90% right, that's still not 100%. So let me give you an example of what I'm talking about. What do we know right now? We know seasonally that these next few weeks have been the most bullish, predictably bullish period of time in the entire year in the stock market. We know that some of the gains have been very dramatic and high probability. We know that, but we don't know it for sure. That's fine. It's okay if we don't know it for sure. That's no problem. What we want to do is take advantage of the information. What else do we know? Going to the S&P, which I'm going to do right now on the chart. Let me do that for you. Just a moment, please. Go to the S&P. What do we know? We know that over the short term, based on the indicators which we know, which are not perfect, but we know that what they are, the trend is down. Based on the moving average channel, the trend turned down right over here. Confirmation of the downtrend. Resistance fails, resistance fails, resistance fails every time. So we have a downtrend. That's what we know. But we also know something else, and that something else is what I told you earlier. That seasonally, this is a bullish time of the year. So on the one hand, you don't want to be short because, first of all, profit targets have already been reached on the short position. On the other hand, you don't want to miss an opportunity for a potentially huge rally. Why do I say that? I say that because, number one, the seasonal is ideally bullish, and fine-tuning it by going to seasonaltrader.com, we come up with between the 12th and the 15th of the month as the turning point. So we're getting very close. So what else do we know? You know that monthly basis, the long-term trend, right over here, we're still in a great big bull market, coming down to the bottom of the channel support, which has held many times since this bull market started a number of years ago. So we don't want to be fooled into selling the market, even though there's potential opportunity here, but we also don't want to be fooled into buying the market just because the numbers are strong. What we need is a trigger. How are we going to do that? I'm going to go back to the daily chart. And this is where fine-tuning comes into play. You can fine-tune long entry. Why long entry? Because that's the path of least resistance seasonally. If you fine-tune long entry by going to an intraday chart, for example, a 6-hour chart or a 3-hour chart, and take your buy triggers from there. Example, let me show you. S&P daily chart. I'm going to switch the daily chart to a 3-hour chart, like so, which would be 180 minutes. And we'll tell you why I'm doing this. Remember, this is fine-tuning, for lack of a better term. Go to the 3-hour chart, 180 minutes. Why the 3-hour chart? Because it's stable. Here's the 3-hour chart. So what does that look like? Well, here we go. 2 bars below the bottom of the channel right over here. Williams below its moving average right over here. Resistance at the top of the channel right over here. Everything is perfect. So what we want to do is this. Wait for the 3-hour chart, or if you want more stability, the 6-hour chart to turn bullish, and then take the buy trigger, because the probability is that the buy trigger will work as we come close to that period of time where seasonals are usually bullish. Looking at the 6-hour chart. I'll also tell you what not to do in a moment. Here's a 6-hour chart. 360 minute. Come on, computer, cooperate with me. Don't let my hand shake. I hate when my hand shakes. 360 minutes. A more stable chart. So, what are you going to do? You're going to wait. Why are we going to wait? Because we don't want to catch the falling knife, but at the same time we want to give the market a sufficient opportunity to give a stable turn. Then you might say, well, why not a 10-minute chart or a 5-minute chart? Because those charts are way too short term. They could turn bullish and bearish 5 or 6 times a day or more and not give you an opportunity to stay in the big trade. So that's my read. I'll be watching very closely the next few days, the 3-hour and the 6-hour chart for a turn to the upside. I will take those triggers when they happen, because they will then be consistent with the seasonal trend. Of course, there's one more thing you could do. Go to the seasonals and pick the trade that's seasonally best for you between the 12th and the 15th, given the right amount of risk for your account size, and take it from there. But again, with sentiment this low, with the seasonal as high as it is, with the long-term trend still very bullish, that's how we combine the information and develop into a trading style. Develop your own style. It will serve you best over time. Hope you enjoyed the lesson. If you did, let me hear from you. If you didn't, let me hear from you. If you have suggestions for further lessons, please let me hear from you, Jake, at trade-futures.com.